October 24th, 1929. The stock ticker in New York runs hours behind reality because 12.9 million shares are changing hands in a single day, nearly triple the normal volume, and the machine physically cannot print fast enough. September 15th, 2008. At 1:45 in the morning, Lehman Brothers files the largest bankruptcy in American history, $639 billion in assets, a 158-year-old firm dead before sunrise. And the third date is blank. 3 panels in a triptych. 2 of them are painted in full, every brushstroke documented, every casualty counted. The third panel is stretched canvas, primed, waiting. Whether anything gets painted on it is the question this entire story is built to ask. Because here's what nobody tells you when they teach these crashes in school. They teach 1929 as a black and white photograph, men in hats, bread lines, a sepia tragedy from another civilization. They teach 2008 as a technical malfunction, acronyms, derivatives, a plumbing failure in the basement of finance. 2 different stories, 2 different centuries, 2 different villains. Except they're not 2 different stories. Lay the ledgers side by side and the entries start to rhyme. The same cheap credit, the same intoxicating new era narrative, the same leverage hidden inside freshly invented wrappers, and the same 5 words spoken with total conviction right before the floor gave way. This time is different. Those 5 words have been called the most expensive sentence in the English language. And by the end of this video, you'll be able to hear them being spoken right now in 2025, and you'll have to decide for yourself what they mean this time. Start in the 1920s, because the rise is where the pattern gets installed. America comes out of the First World War as the world's creditor. The economy grows at a clip that feels like destiny. Between 1922 and 1929, gross national product expands by roughly 40%. And there's a story attached to that growth, which matters more than the growth itself. The story is technology. Radio reaches into millions of living rooms almost overnight. The Radio Corporation of America becomes the glamour stock of the age, climbing from around $85 a share in early 1928 to a 1929 peak that, adjusted for splits, represented a gain of several hundred% in under 2 years, and RCA paid no dividend at all. None. People weren't buying earnings, they were buying the future. Automobiles, electrification, assembly lines. Every headline confirmed that humanity had crossed into a new economic era where the old rules of valuation were quaint relics, like candlelight. And the fuel underneath the story was credit. Cheap, abundant, and structurally reckless. Investors could buy stocks on margin with as little as 10% down. Put up $1,000, control $10,000 of stock. By October 1929, brokers' loans, the money lent to speculators to buy shares, had swelled to roughly $8.5 billion ADGI, some larger than the entire amount of currency circulating in the United States at the time. Let that one sit for a second. The borrowed money-chasing stocks exceeded all the actual cash in the country. Corporations themselves got in on the lending because loaning money to speculators at 12% or more beat building factories. The machine was eating its own seed corn and calling it a harvest. Then there were the wrappers. The 1920s invented the investment trust, a company whose only business was owning shares of other companies, often other investment trusts, which owned shares of still more trusts. Leverage stacked on leverage, a hall of mirrors where $1 of real value could support several dollars of paper claims. In 1928 and 1929 alone, hundreds of new trusts were launched, raising billions. Goldman Sachs created the Goldman Sachs Trading Corporation in late 1928. It issued shares at $104, traded as high as the 220s, and would eventually fall under $2. John Kenneth Galbraith, writing decades later in his History of the Crash, observed, In essence, that the trusts had performed a kind of financial alchemy. They created no new wealth, only new claims on existing wealth, layered so deep that almost nobody could see the bottom. Now, slide the lens forward 70 years and watch the same scene rebuilt with better lighting. The 2000s had their own new era story, and it was even simpler than radio. American house prices do not fall nationwide. They never had, not in the modern data everyone consulted, so the assumption got welded into the models as something close to physical law. The Federal Reserve, fighting the dot-com bust and the shock of 2001, cut its benchmark rate to 1% by 2003, the lowest in over 4 decades at that point, and held it there long enough for a generation of mortgages to be priced off nearly free money. Lending standards didn't just loosen, they dissolved. Subprime mortgage originations ran into the hundreds of billions of dollars a year by the mid-2000s. By some industry estimates, around $600 billion in 2006 alone, roughly a fifth of all mortgage lending that year. No documentation loans, teaser rates. The 1920s speculator put 10% down on stocks. The 2000s borrower sometimes put 0% down on a house. Same chemistry, different molecule. And the rappers came back too, wearing new suits. Where 1929 had investment trusts stacking claims on claims, 2008 had the collateralized debt obligation. Thousands of mortgages bundled into bonds. The bonds sliced into tranches. The riskiest tranches rebundled into new CDOs, and those resliced again. CDOs squared. By the peak, the global market for credit default swaps, side bets on whether all this paper would pay, carried a notional value in the tens of trillions of dollars, a figure larger than the entire output of the world economy. Once again, $1 of real value, a family making a mortgage payment in Stockton or Tampa, was holding up a tower of paper claims that nobody, and I mean nobody, could fully map. Sound familiar? It should. It's the same hall of mirrors, rebuilt with spreadsheets instead of stock certificates. Quick aside, and this is the part that gets me every time I read these histories back to back. The people in both eras were not stupid. That's the lazy explanation, and it's wrong. The 1929 trust designers and the 2008 CDO structurers included some of the sharpest quantitative minds of their generations. Intelligence was never the missing ingredient. What was missing was doubt. Carmen Reinhart and Kenneth Rogoff, surveying 8 centuries of financial crises, found essentially the same syndrome everywhere they looked. Each generation convinces itself that the old rules have been repealed, that the lessons of previous crashes don't apply, because something, the technology, the regulation, the sophistication, is genuinely new this time. The tools change every era, the sentence never does, so those are the manias. Now the warning signs, and this is where the two ledgers stop rhyming and start matching. Line for line. Warning sign 1, the smart money starts leaving while the loud money keeps shouting. Through 1929, insiders and some bankers were quietly trimming positions even as new investors poured in. Roger Babson warned publicly in September 1929 that a crash was coming and was ridiculed for it. In 2005 through 2007, a handful of fund managers were buying protection against the mortgage market. The trades later made famous, while the heads of major institutions reassured everyone. In July 2007, Citigroup's chief executive told the Financial Times that as long as the music was playing, you had to get up and dance. The music had, in hindsight, already stopped. Warning sign 2. The regulators see the smoke and call it weather. The Federal Reserve in 1929 fretted about speculation, but feared that raising rates hard would strangle legitimate business. It tightened too little, too late, then stood paralyzed. In 2005, with subprime lending at full boil, Official assessments from the Fed leadership famously suggested that housing showed signs of froth in some local markets, but that a national price decline was improbable. In both eras, the institution holding the fire hose spent the critical years debating whether the building was actually on fire. Warning sign 3. Leverage migrates to where the rules can't see it. In the 20s, the margin loans and trust pyramids sat outside any meaningful oversight. The Securities and Exchange Commission didn't exist yet. In the 2000s, the risk pooled in the shadow banking system, off-balance sheet vehicles, money market funds, repo markets. Institutions that functioned like banks, borrowed like banks, but carried none of a bank's safeguards. Lehman wasn't a deposit-taking bank. That's precisely why it could lever itself to roughly $30 of assets for every $1 of capital, and why a 3 or 4% move against it was fatal arithmetic. Warning sign 4. Valuations detach from the thing being valued. By September 1929, the Dow had risen roughly five-fold from its 1921 low. By 2006, the National Home Price Index had roughly doubled in under a decade while household incomes crawled. And warning sign 5, the tell, the one that shows up in every crisis Reinhardt and Rogoff cataloged. Ordinary people start borrowing to join the party, because the party has gone on so long, it looks permanent. Shoeshine boys giving stock tips in 1929, house-flipping seminars in hotel ballrooms in 2005. When the speculation becomes folk wisdom, history suggests the clock is already running, and in both eras, the first crack appeared months before the crash, small enough to explain away. In March 1929, the market broke sharply and recovered. In the spring of 2008, Bear Stearns collapsed into a forced rescue, and the market rallied through the summer anyway. The fire alarm rang. Everyone agreed it was a drill. Then, the third act, and it deserves to be told the way it happened, fast and in 2 times at once. Thursday, October 24th, 1929. By mid-morning, the selling is an avalanche. Prices on some stocks gap down dollars at a time between trades. Outside the New York Stock Exchange, a crowd gathers on Broad Street. Thousands of people, mostly silent, just standing in the autumn air watching the building as if it could tell them something. Police are deployed. Inside, the ticker, the only way most of the country can know its own net worth, falls 1 hour behind, then 2, then 4. A man's ruin could be complete for hours before the tape got around to informing him. At noon, the heads of the biggest banks meet at J.P. Morgan and Company and send the exchange's vice president, Richard Whitney, onto the floor to bid above market for U.S. Steel, a theatrical show of confidence. It works for about 3 days. Monday, October 28th, the Dow falls about 13%. Tuesday, October 29th, Black Tuesday, another 12%. On more than 16 million shares, a volume record that would stand for nearly 40 years. In those 2 sessions, roughly $30 billion in paper value evaporates. More, it was often noted at the time, than the United States had spent fighting the First World War. The margin loans now run in reverse. A 10% decline doesn't dent a leveraged investor, it deletes him, and the forced selling forces more selling. The trusts, those mirrored halls of leverage, collapse inward. Goldman Sachs Trading Corporation, the $220 wonder, eventually under $2. And here's what the textbooks compress. The crash wasn't an event, it was an erosion. The market kept falling, with rallies that broke hearts along the way, until July 1932, when the Dow bottomed at 41, down 89% from its peak. 89%. A dollar became 11 cents, now intercut. Weekend of September 13th and 14th, 2008. Inside the Federal Reserve Bank of New York, the heads of Wall Street are summoned to find a buyer for Lehman Brothers. Barclays nearly takes it. The deal dies in London on Sunday. There will be no rescue. And at dawn on Monday, September 15th, the cameras catch the scene that became the 2008 equivalent of the crowd on Broad Street. Lehman employees walking out of the tower at 745 7th Avenue carrying cardboard boxes, gym shoes, desk photos, 20-year careers under the building's giant wraparound LED ribbon, still cycling its cheerful colors above them like nothing had happened. 25,000 jobs at Lehman alone. Then, the 72 hours that nearly broke the system. Monday, Merrill Lynch sells itself to Bank of America in a shotgun weekend deal. Tuesday, September 16th, the government commits $85 billion to keep the insurer AIG alive because AIG had written credit default swaps against the whole mirrored tower and could not pay. The same day, a money market fund, the Reserve Primary Fund, breaks the buck, its share value falling below $1 because it held Lehman paper. And suddenly, the safest-looking corner of finance is running like a 1930s bank queue, just electronically, silently, at the speed of a mouse click. In the following weeks, the Dow posts its largest single-day point drop to that date, 707 points on September 29th, when the first rescue bill fails in Congress. Global equity markets shed on the order of $30 trillion in value over the course of the crisis. In the United States, household net worth fell by roughly $13 trillion. Nearly 9 million jobs were lost. Millions of homes went into foreclosure. Different wrapper, same physics, a tower of claims, a missing dollar of real value at the base, and gravity. Here is where honesty matters more than drama, though, because the aftermaths were not the same, and the difference is the most hopeful line in this whole ledger. After 1929, the Federal Reserve made what most economic historians now regard as the central catastrophic error. It let the banking system die. Between 1930 and 1933, something like 9,000 American banks failed. There was no deposit insurance. When your bank died, your savings died with it, and the money supply contracted by roughly a third. The crash became the Great Depression. Unemployment near 25% by 1933, industrial production roughly halved, a decade of want, and political consequences across the world that ran far darker than economics. The crowd outside the exchange in 1929 went home to a country with no safety net underneath it at all. In 2008, the people running the response had spent their careers studying exactly that failure. The Fed's own chairman was a scholar of the Depression. And within weeks, not years, the playbook inverted. Rates to zero. Hundreds of billions in capital pushed into the banks. Guarantees thrown across money market funds. Deposit insurance, born in 1933 out of the previous catastrophe, held the retail banking system together so completely that ordinary savers never lined up on a sidewalk. It was ugly. It was unfair in ways people are still angry about, and the recession was the worst since the 30s. But unemployment peaked at 10%, not 25%, and the banking system, whatever else you say about it, did not cease to exist. The lesson of Panel 1 was, at terrible cost, actually learned by the painters of Panel 2. That matters. Anyone who tells you history, repeats exactly, is selling the drama and skipping the data. The pattern in the rise rhymes almost perfectly. The pattern in the response, so far, has not. Which brings us to the third panel, the blank one. Let's do the checklist honestly, line by line for 2025. Cheap credit. Check, with an asterisk. From 2008 to 2022, the developed world lived through the longest stretch of near-zero interest rates in modern history, plus trillions in central bank asset purchases. An entire generation of investors, founders, and lenders built careers without ever seeing money cost anything. Rates have since risen and partially eased again, but the structures built during the zero era, the valuations, the debt loads, the assumptions, are still standing on the old foundation. Global debt, public and private combined, has been estimated by institutional trackers at well over $300 trillion, several times world output. U.S. federal debt alone passed $36 trillion. Nobody knows what the carrying cost of all that paper does to the system over a decade, and that uncertainty is the asterisk. A new era story. Check, unmistakably. The 1920s had radio. The 2000s had housing never falls. The 2020s have artificial intelligence, a technology that may genuinely transform the economy, just as radio and homeownership were genuinely real. That's the trap in every panel. The story is always partly true. RCA's radios worked, the houses existed. The question is never whether the technology is real. It's whether the prices have outrun anything the technology can deliver on the timeline the prices assume. By 2025, a handful of technology companies accounted for an outsized share of the entire U.S. stock market's value. By some measures, around a third of the S&P 500 concentrated in roughly 10 names, and capital spending on data centers was being measured in the hundreds of billions per year. Some economists call it the build-out of the century. Others hear an old melody. Both could be right about different verses. Leverage in new wrappers, check. And this is the line that should make students of 1929 sit up. The investment trust hid leverage from 1929's regulators. The CDO hid it from 2008's. Today, an enormous share of corporate lending has migrated into private credit, funds that lend directly to companies outside the banking system with valuations marked privately rather than priced daily in public markets. The asset class has grown from a niche into something estimated at well over $1.5 trillion globally. It may be perfectly sound. It is also, by construction, exactly where. The warning sign 3 pattern says risk goes outside the brightest lights, into structures whose true condition is hardest to see from the street. And the 5 words, you can find them in 2025 without looking hard. This time is different because the AI productivity gains are real. This time is different because the banks are better capitalized. Some of those sentences may even be true. They were partly true in 1928 and 2006 too. But the panel is blank, and I'm going to keep it blank because that's the only honest way to end this. The differences are real. Deposit insurance exists. The banks carry far more capital than in 2007, and the central bank has demonstrated twice now, in 2008 and again in the brief banking scare of March 2023, when regulators backstopped depositors within 72 hours of Silicon Valley Bank's failure, that it will move in days, not years. Maybe that's enough. Maybe the third panel gets painted as the crisis that never came, the mania that deflated gently, the lesson finally absorbed. Or maybe, as Reinhardt and Rogoff's 8 centuries of evidence keeps suggesting, the safeguards built after each crisis are always shaped like the last one, and the next one always arrives through the door nobody reinforced. The ticker fell behind in 1929. The risk models fell behind in 2008. What falls behind this time, if anything does, is the one entry no ledger has recorded yet. 3 dates: October 24th, 1929, September 15th, 2008. And a duo, third one that doesn't exist yet, or perhaps ever. The pattern doesn't repeat exactly whatever the thumbnail says. It rhymes, and the rhyme is loud right now. But the third panel of this triptych is still unpainted canvas, and the brush is in the hands of people making decisions this year, this quarter, this week. So the question isn't whether history will repeat. The question is whether we're the generation that finally hears the rhyme in time, or just the next one that swears with total conviction that this time is different. If you want to see what happens when a country ignores every warning sign at once, the full story of how Weimar Germany's money died in a matter of months, That's the next chapter of this ledger, and it's waiting for you in the video on your screen now.